Good morning, everyone, and welcome to our Economic Update webinar. My name is Lisa. I'm the Marketing and Communications Manager at O'Brien's, and thank you very much for joining us today. This is our final webinar for the year. We've been running them over the last, well, probably 2 years actually. And given the market fluctuations during this time, our clients have found this to be valuable in understanding the impacts and just refocusing on the importance of remaining focused on the long-term strategy. Today, I'd like to introduce Ross Cassidy, Investment Specialist at Morningstar, and he's going to present to us a review of the year to date and just look at how we're settling into our new old normal. We'll take questions at the end of the session, so if you have any, please use the Q&A box at the bottom, and I'll be on the session managing any technical issues. If you have them, please let me know. Following this event, if you have any questions in regards to your personal situation, please contact our financial planning team. Nellie and Tracy are both available to discuss your personal circumstances. So I'll hand over to Ross. Thank you.
Thanks, Lisa. Look, thanks everyone. I appreciate you taking time out of your day to come and listen to me. Hopefully you get at least a couple of pieces of information that you find useful. As Lisa said, my name's Ross Cassidy. I'm an investment specialist here at Morningstar. And yeah, I'll be taking you through what's happened and what we think is sort of coming up on the horizon. Before I do start, just some important information. Everything I discussed today is obviously general in nature. I haven't taken into account anyone's circumstances as I've sort of done this and prepared this presentation. If you want to speak to someone as it relates to your personal circumstances, obviously you can contact the guys at O'Brien's. I thought it's important, just as I kick off, important to, I guess, at a really high level, discuss the approach that sort of have at Morningstar, which will really give you a lens to how we sort of see things, and we'll set up sort of the remainder of the presentation. So we've got these three, I guess, underlying premises for what we think are sound investment decisions. I don't think any of them are too outlandish, and they should all make sense to everyone conceptually. First one, which we think is really important, is the price you pay for an investment matters. So, you could invest in the greatest company in the world, but if you pay too much for it, then there's a higher likelihood that you could experience losses in that investment. So the price that you pay for things matters. The second one we've got is it's always better to buy quality investments. So what we are looking to do at Morningstar is we value around about 400 different assets and asset classes to try and work out what's undervalued and overvalued. And look, as we're doing that, it's not just not necessarily a process of finding things that are cheap. We want to find things that are undervalued but are of quality. So the quality of investment matters as well. And I guess the final one, investors tend to act irrationally and markets tend to act irrationally, particularly in the short term. So, this is where we think active management is really important to take advantage of some of those market inefficiencies. So as you can sort of see there at the bottom, said another way, the opportunity to buy attractively priced assets typically comes when no one else wants them. And this is really how we are looking at things on a day-to-day, month-to-month, year-by-year basis. So I guess to put that into, a graphical representation as we're going through this process, this is really what we're looking to do. So you can see hopefully you can see my cursor there, that orange line through the middle is what we call fair value. And this is the price that we're assigning to assets. As I said, we are valuing around 400 different assets and asset classes every month. So we assign this fair value to them. And what you tend to see is, fluctuations above and below that fair value. So if we can pick up assets of quality that are undervalued, so at this sort of lower end here to their fair value, it gives us what we call a margin of safety, which is this sort of dashed line here. So if we can pick these things up here, we're not saying that we're going to necessarily pick the bottom of that particular asset class, or the lowest point it's going to get. But if we've got this margin of safety, then we feel like it puts us in a great position to, I guess, minimize further losses, but then conversely, potentially pick up some larger returns. So we think picking things up here is better than picking things up here, where you still may pick up some of the upside, but your potential for losses becomes greater. So this is really what our process sort of boils down to. And like I said, I thought it was important to, I guess, give you that context around how we see things in markets for the remainder of the session. So what's been driving portfolio returns or asset returns in the financial markets year to date? Now, what we've got here is year to date asset class returns on some of the major asset classes. It is a little bit dated. It's the middle of November, but by and large, you can see that year to date, it's been a pretty tough time for investors. So I'm probably telling you things that everyone knows. Major markets within equities have been down significantly. If I had have shown you this chart at the end of September, these all would have been red. So all major asset classes were basically down up until the end of September. And we're obviously starting to see some green shoots now, and a couple of asset classes are turning around and showing a positive return year to date. You can see the ASX 200 here. You've also got the UK market and a couple of others. But by and large, year to date, it's been a pretty tough time for investors, not just in equity markets, share markets, but also in listed property markets, as well as bond and fixed interest markets, which we can see down here. Now, I know bonds can be a little bit perplexing as an asset class, but if you think of bonds as really just a term deposit that you can buy and sell, if you can get your head around that concept, you're sort of more than half the way there to understanding sort of how they work. But like I said, year to date, it's been a pretty tough environment for investors all round. But if you take a back and take that longer term view, time in the market, not timing the market. The last 10 years has been a great time for investors. So you can see here significant returns across most asset classes over the trailing 10-year period up until sort of the middle of November of this year. So really important to, I guess, control that behavior, understand that, there might be some short-term noise now, but over the trailing 10 years, it's been a great environment for investors, which I think is really important to understand. Now, the thing that's been driving markets recently, or pushing them around and making them a little bit more volatile, has really come down to central banks and inflation and potential risk of recession. So it's a little bit of a busy chart here, and I won't sort of explain it all, but really what we've got is the inflation numbers for a number of key markets: UK, US, Australia. And really what I wanted to point out here is I guess the magnitude and how quickly that inflation has spiked across all major markets. And you can see that this uptrend here on all of these lines, it's been a significant spike over a really, really short period of time. Now, because that has happened, that's I guess forced assets to start to what we call reprice. And that's what started to push, the asset prices around, and has caused some pain for investors over the short term. Now, this chart is just showing the inflation figures within the US. We've got the headline CPI, so you can see here that's at 7.7%. But we've also got the core number. So the core figure looks to take out some of those volatile pieces of the basket that make up the CPI number, namely being food and energy. And even though in recent times the headline CPI number in the US has rolled over and started to come down, I think the important thing to note here is the CPI core number has been pretty steady at around that 6 to 6.3%. So yes, it's great that the headline number is starting to roll over, but what the central banks will at is this core CPI number. And the reason, the US number is so important is really in and around the fact that when, generally speaking, when we're pricing assets, it's usually the 10-year Treasury, which forms the US Treasury, which forms the baseline of all asset prices. So that's why markets generally tend to look at, the US for their inflation figures and bond yields and those sorts of things as well. So again, another thing that the central banks are going to be looking at is the job markets and wage inflation. So what we've got here is, again, that core CPI number in the blue, which, as I said before, is around that 6.3%. But we've also got the unemployment figure here, which is that sort of maroon coloured line, which is really, really low at nearing around 4% in the US. Now, why this will be, I guess, of importance to the Federal Reserve is because of the fact that labour markets are so tight. I don't have the exact numbers, but ballpark, there's around 10 million jobs that are sort of open and available throughout the US. But the unemployment number is around 6 million. So effectively, you've got more jobs and vacancies than you have people to fill them. Now, what that is doing is, if people want to fill those jobs, they have to pay more to get those jobs filled. So wages are starting to increase, and that wage inflation is starting to increase. Now, why that's important for central banks is if you get this embedded wage inflation, you've basically got two things that can happen. Companies can pass that on to the end consumer or the end client, which then sort of creates this self-fulfilling prophecy of more inflation, or they can sort of take that and sort of trim their margins, which again isn't great for companies. So this is another point that central banks will be sort of taking some time to have a look at. Now, you might say, that's great, that's fine, Ross, that's all very technical, but can you tell us sort of what you think is going to happen going forward? Now, what we've got here is a survey that comes out of the University of Michigan. And basically what we have here in the blue line is the CPI or inflation expectation for 1 year. And then in that maroon coloured line, you've got the expectation for 3 years. So as you can see here, expectation for inflation in the next 12 months is around 4.9% in the US. So we think that will continue to come down, and that will likely be the case in most major markets. It will start to come down. It will still remain high, but over the longer term, this 5-year number, you can see it's around 3%. So what that kind of indicates is we think that central banks largely will bring inflation into account and under wraps, and sort of bring that towards the top end of the band. Most people hear the band of 2 to 3% for inflation. So it will sort of be brought under wraps, but at that upper end of the band in the sort of medium to longer term, which we think is really, really important. We don't want a period of sort of that sustained inflation as we saw through the 70s. Now, expectations on the cash rate. This is as it relates to the RBA or Australian numbers. Now, this chart is a little bit old. What we've got here is what the actual cash rate was, and the implied or market determined cash rate in the blue line. Now, obviously, these have both converged at December at around 3.1%, which is very close to what that market was predicting from sort of October onwards. But what I wanted to point out here is the expectation for rates for December 2023. So this is this orange-red sort of triangle we have here, and that's at around 3.75%. So the market's expecting the cash rate to get around 3.75% come the end of 2023. So, that clearly indicates that we think there's still a couple of interest rate rises to come from the RBA. most likely to sort of occur in the front end of 2023, with a pause towards the back end to see how these rapid increases to the cash rates have played out, because there is a little bit of a lag between when the RBA raises rates and sort of how that filters through into markets and economies and those sorts of things. So all of that said, this is a quote that Peter Costello made at an event I was in Adelaide in September, and he said, the great news is you've just lived through the greatest investment decade of the past 100 years. And the bad news is you've just lived through the greatest investment decade of the past 100 years. So we think that's sort of a really pertinent quote, and sort of, ties into, the headline of this presentation is "Welcome to the New Old Normal." We think we're going back to a period of greater volatility, and asset classes not returning maybe as much as they have over the previous 10 years. So looking ahead, the only certainty is uncertainty. We've got a backdrop of COVID, pandemic, war, inflation, geopolitical risks through Russia, Ukraine, China, Taiwan, the chance of recession. So there's a number of factors that are sort of in the backdrop to economies and financial markets, and all of this creates uncertainty, and with that uncertainty generally comes some volatility within the markets. So what we've got in this next slide, without being sort of too technical, is the VIX index, and what the VIX index tracks is at a really high level volatility within the markets. So we've got that over 3 different decades here. Now, this green line was the previous decade, so from 2010 to around sort of 2020, and that averaged at around about 16.9%. Now, that doesn't mean much to anyone, but the average of this VIX index is around 20 to 21%. So it might not sound like a huge difference, but if you sort of boil it down, it comes out at around about a 20% reduction in volatility across markets for the decade. Bearing in mind that we've also got the that COVID period, or the COVID drawdown, where there was sort of increased volatility. So what this is really showing is the previous decade was really stable, not a lot of volatility within markets, which isn't normal. We've probably become accustomed to this low volatility environment, but important to note that this is unusual. It's not the norm. As I said, the norm's around about that sort of 20% mark. Now, as I said, in greater volatility tends to come, I guess, more challenging environments for investors. Now, bear with me while I talk you through this. What we've tried to do here is just create a simple reference. Create a simple reference portfolio, which you can see on the left-hand side here, and it's a 70-30 portfolio, 70% in growth assets, 30% in defensive assets. We haven't done anything sort of too clever with it. We've just split the growth assets between Australian shares and international shares. We've split the defensive end between Australian bonds and international bonds, and then we've got a cash component. And what we've said here is, if you had this portfolio only invested in index type exposure and you've rebalanced it every quarter, so like I said, nothing too clever, what would the outcome have been in terms of returns and achieving goals, which would be equal to CPI plus 3.5, which is the objective of a Morningstar growth or 70-30 portfolio. How often would you have hit that goal on a rolling 3-year period through the different decades? And as you can see here, for the most recent decade, sort of 2010 to that's September 2021. If you had this simple reference portfolio, you would have met that objective 96% of the time. So basically what this is saying is you only needed market exposure, you only needed to be invested, and you probably would have had a pretty reasonable outcome. Now, as I said before, that lower volatility, particularly created by central banks and easy money and accommodative policy, has really driven that lower volatility, which has sort of helped asset prices by and large, across the board. As you can see here, the average that portfolio would have met that objective is around 60%. So the last decade, to Peter Costello's quote, is, you've probably just lived through the greatest decade of the last 100 years. And this sort of proves that point here. Now, with all of the, with the backdrop of the of war and pandemic and energy shocks and inflation and recession risk and those sorts of things, which we discussed earlier, you could draw parallels back to the 70s where we had war, we had inflation, we had energy shocks and those sorts of things. And you can see here that portfolio would have met the objective only 26% of the time. Now, I'm not saying that this is where we're heading. We're not necessarily heading to that 70s type of environment. But what I am saying is don't expect the environment of the 2010 to 2020 in terms of your asset class returns. And we think that this is where active investment is going to be crucial in terms of being able to meet those objectives. Now, what we've got here is just a really simple demonstration. The green line here is the economic cycle, and the blue line here is the market cycle. And what we've got here in this sort of darker green box is where we are at the moment. So on that market cycle, we're in a period of markdown. So asset prices and returns have been negative. Assets have been repriced and marked down, and in this green line, we've got sort of in this sort of potential recessionary period. So this is where we're at the moment, and I don't think you need to be a genius to sort of work that out. You just you read the media and have a passing interest in markets, and you'll understand this. So this is where we're at the moment. The pleasing thing is internally here at Morningstar, we're starting to position our portfolios for this accumulation phase. So we think we're actually getting closer to the trough, not necessarily saying we're going to pick the bottom, but we think we're getting closer to the trough. So a lot of the pain that's played out, we think is sort of behind us. So if you have a look here in this accumulation phase, valuations are starting to become attractive, which we're seeing. Sentiment is negative, which we're obviously seeing through markets and those sorts of things. But there are some green shoots, as I sort of said before. Now, what this chart is showing is the price to earnings ratio across a number of different markets. So basically, you can see that, in the US, that blue line, it's coming down. In developed markets, it's coming down. In emerging markets, it's coming down. So this is the story around those asset prices revaluing and valuations becoming more attractive. Now, if we look at that on a more micro level, as I said before, at Morningstar, we are valuing around 400 different assets and asset classes on a monthly basis. And this is just a subset of those, comparing in the dark blue line, September 2022, and in the light blue line, September 2021. And you can see the difference between those there. So, with Chinese shares, you can see that the valuation implied return on that, which is what we're doing every month, is around 11% at the end of September versus around sort of 5% at the end of September 2021. Global communication services, so I think your Googles and Facebooks and those sorts of things, you can see that the valuations are becoming much more attractive, around 7% end of September versus basically nothing at the end of September 2021. And a lot of this has been a function of the fact that asset prices have come down. So, you think, as I said before, Facebook, for example, year to date, that's down around 60 or 70 odd percent. So we prior to sort of September or so of this year, we had purposely steered clear of those sort of overpriced assets. So your Facebooks and your Amazons and your Googles, not necessarily on the fact that we thought they were bad companies. We thought they were great companies, but to the earlier point before, we thought that they were extremely overvalued, and the price that we pay for things matters. So that's why we steered clear of those. Now, because a lot of those are down sort of 50, 60, 70% year to date, we said this is a really, really opportune time to push into and start investing in some of those companies, which we've started to do towards the back end of this year, based in and around our valuations. So you can see across the board here, nearly all of those asset classes with the implied returns has improved year on year from September 22 to September 21. So as I said before, the valuation piece and valuations are starting to become much more attractive. Now, what we have here is at the end of September of this year, we've basically got the direct equities that we hold in our growth managed account or our growth portfolio. Now, a lot of these names will be familiar to you, ANZ, James Hardie, CSL, Westpac, really, really quality companies, great names. But really what we're trying to demonstrate here in those red lines, a number of the companies that we've been able to add to our portfolio off the back of, better valuations. And that's sort of occurred in the previous quarter. So we've been able to add CSL, we've been able to add ResMed, we've been able to add ANZ and James Hardie to the portfolio. Again, almost buying those or acquiring those at a sale price, which we think is going to, set up our investors longer term. So to be able to invest in these quality companies at a more attractive rate. Now, you may have a question of what does moat mean? No moat, narrow moat, wide moat. And really, that's just an internal reference that we have, which talks to the barriers to entry for that particular company. So, if you think of the old castle, and it used to have a moat around it, which was your defence or your barrier to entry from those who wanted to invade and attack you, that's what that really talks to. So, if you think of it, conceptually, that wide moat, greater barriers to entry, ANZ's obviously in there, Westpac's in there. We've got the big four banks in Australia. We're very, very unlikely to see the big five banks anytime soon. So huge barriers to entry. So that's what that moat narrative is sort of referring to. Now, as I said before, the US communication services and global communication services is starting to become much more attractive from a valuation perspective, and this is what this chart is really trying to show. If you have a look at that sort of August-September period here, we had an implied valuation and return that was basically negative for a lot of these bigger overvalued companies. Now, as those companies have repriced and revalued, you can see that the valuation implied return has become more and more attractive. So, as I said before, we're starting to invest in some of these companies, your Facebooks and your Alphabets, which is Google. So we're starting to do that because those valuations are starting to become much more attractive over that longer term, and the implied returns are much better. So, as it says here, emerging opportunities after a long period of being unattractive, which is the reason why we've tended to avoid those companies. Similarly, with Chinese equities, you can see here that the implied valuation return has become much more attractive. Now, I guess the caveat around that is the way in which we look at that is not necessarily trying to find, as I said before, the cheapest assets or those with the best implied returns. We've got a number of metrics that I guess underpin our investment decisions. One of those being around fundamental risk or risk of loss of capital. Now, obviously in the Chinese market, there's some huge geopolitical risks. So even though the implied returns for your Tencents and your Alibabas are really, really attractive, we're also really cognizant of the fact that there's some huge geopolitical risks here. Who's to say that the CCP doesn't wake up and decide to nationalise some of these companies, which isn't a great outcome for investors. So even though we're starting to push into this area a little bit with our portfolios, we're taking some small, sensibly sized positions, taking into account some of those geopolitical risks. So again, as we've sort of got here, risk matched by reward with an attractive margin of safety. So that margin of safety that I talked about before, particularly for Chinese equities and some of those geopolitical risks, that margin of safety has to be much, much bigger for us to, I guess, consider getting into some of these areas. Now, what we've got here is the 10-year yield on some government treasuries. We've got the US in that red line. We've got the Aussie market in the green, the UK in blue, and the German market in yellow. Now, without sort of getting too technical on the bond side of things, the reason that I've got this chart up is to really show how bonds, which are your sort of interest-bearing type of assets, they've gone from sort of really low yields or next to no income being paid for holding those assets to actually having some income if you're holding these type of instruments or these bonds. So going from basically zero back in sort of 2020 or mid 2021 to earning an income or a coupon payment from these, we think is a really good outcome for investors. So those investors who are a little bit more conservative or are looking for that income, they can start holding some of these assets and sort of getting that coupon payment for the foreseeable future. So a much better environment. And again, those green shoots are starting to appear in a number of different asset classes, not just within equities, but also on the defensive end and your fixed interest and your bonds. Now, all of that might be really, really interesting, but what we have tended to find is investor behavior is sometimes a greater determinant to outcomes than what's actually happening in the market. So it's normal for markets to go through periods of weakness and volatility. Volatility is actually a feature of the market. It doesn't mean the market's broken. So again, moving back to the old new normal, where there's a little bit more volatility. But it's how investors react to that, or what you do in those periods of volatility. And we think if you zoom out and take that longer term view, we showed you the 10-year returns in one of the very early slides, and that's been a great time for investors. So taking that longer term view, controlling your behavior, not sort of being overly emotional, to some of the noise, that short-term noise, we think is really, really important. And in our experience, that's where a good financial planner can help you through some of that behavioural type of stuff, and make sure that you're concentrating on your longer-term goals and those things. So really important to make sure that your behaviour and how we're reacting through this short-term noise is important. And I guess what we've got here in this final chart is just an illustration of how some of that can play out. Now, what we've got here in this sort of shaded blue-grey type of bar is the period of the GFC, global financial crisis. Now, as I said before, we're not saying that we're necessarily calling the bottom of the market. We think we're closer to the trough than we are previously. But what this is showing is with this yellow line, if you had $100,000 invested and sort of held that through that GFC period, if you had have got nervous around this bottom area here, withdrew it and went to cash, what would have been your outcome for the following sort of 10, 15 year period? Now, this yellow line shows that if you if you pulled out that $100,000 investment and switched it to cash, it would now be worth around $160,000. If you had to pull that out and said, I want to sit on the sidelines for a little while, I'm a little bit uncomfortable, but I want to come back in. I want to come back in maybe a year's time. So if you had have done that, pulled it out, gone to cash for a year, and then reinvested, what would the outcome have been? And this red sort of maroon type of line, your $100,000 investment would now be worth around $310,000. But if you had a sort of held steady, held the course, understood that volatility is normal and can happen within markets, but sort of concentrated more on those long-term goals, the $100,000 investment at this point in time would now be worth around $530,000. So to my point before, we can sometimes find that investor behavior is a greater determinant on outcomes than actual markets. So we think that's a really, really important thing to know. And with that concludes the presentation. I hope you got a fair bit out of that, and happy to take any questions.
Thank you, Ross. Really appreciate your time and the effort that's gone into those slides and your explanations. And certainly that last point is something that we share with our clients regularly, is just sticking with that long-term strategy. If anyone has any questions, please feel free to drop them in the box below, or even if you do wish to raise your hand on the bottom of the screen, I can turn your mic on if you'd like to speak directly with Ross. We will be sharing this presentation as a recording, so if there's anything in there that you do wish to listen to again, that will be out tomorrow, so I can send that out to you and available on our website. And it doesn't appear that we do have any questions today, so thank you all very much for joining us. Hopefully you found that valuable. We are next year looking forward to offering some of these seminars face-to-face again, so look forward to welcoming you into the office and collaborating with Morningstar again. So thanks again, Ross, and everyone enjoy your festive season. We appreciate you being with us. Oh, sorry, there is.
There's a question.
There is one quick. Oh, that was just a thank you. Thanks, Jill. Appreciate it.
Thank you
very much. Bye-bye.
Yes, bye-bye.